And we do see the markets opening little changed here. The S&P 500 up just about 0.1%, adding to fractional gains yesterday. It was up about 0.3%. Then seems like we're sort of in a holding pattern, still hovering right near record highs ahead of these inflation reports this week. And joining me now to talk more about the economic data and what it means for equities is Daniel Altman. He's a founder of High Yield Economics. Daniel, great to have you on the show this morning. What do you make of the market at these levels?
The market still looks kind of overvalued to me, I got to be honest. If you look at any historical measures of price to earnings ratios with trailing earnings or future earnings, these are exceptional times. And it's very hard to know how long the market can keep defying gravity, even driven by these big AI companies and other tech companies. It's been known to happen for 12 to 18 months in the past, but every crash that's happened after these kinds of valuations has been quite sharp and not gradual.
I do want to talk about the data that we're going to get on tap this week because, of course, it does fit into the Fed's dual mandate and the path forward for interest rates. Certainly, probably the biggest topic of conversation for traders. So the producer price index for August expected to rise 0.3% from the month before, up 0.9% from the same time a year ago. How does that factor into the Fed's decision and thus the impact on stocks?
The Fed is in a tough place because it's got to balance its mandate for stable prices against its other mandate for maximum employment. Right now, it looks like labor demand is quite slack, but labor supply has also been fairly slack this year. It's not necessarily urgent to support the labor market, but I think the Fed will do a small cut. And the reason for that will be to see how the market and how the economy react. We know that inflation is still above target here. It's above target on the producer price level. It's above target on the consumer price level. We expect that to continue, especially as firms try to pass on more of tariff costs to the consumer. But we also know that some of the forces that are keeping inflation high have nothing to do with tariffs or even the economic cycle at this point. And so the Fed has to be extremely careful.
How would the equity market react if we get a 0.25 percentage point basis cut versus a 0.5 percentage point cut when the Fed next decides on September 17th?
I think the market has at least a 0.25 point priced in right now, some small chance of a 50 basis point cut. So a 50 basis point cut would result in some type of boost to equities, at least in the short term. But, the Fed, another reason for it to be careful is that an asset bubble could be growing here. And while the Fed has said in the past through various officials and research reports that it's not a big fan of trying to burst or even identify asset bubbles, you got to believe that the Fed is treading very carefully here if they also agree that the markets are overvalued.
What are typical signs that signal an asset bubble to you?
Well, these ratios that we're seeing are exceptional. That's certainly one thing that can do it. We also see just a few companies that are really pushing the market in this direction. We are also seeing a situation where the long-term end of the curve, of the interest rate curve, is probably going to stay fairly stickily high even as short-term rates come down. And that's because of a lot of concerns about long-term financing of budget debt for countries around the world and other factors that are just keeping the long-term rates higher. So in that situation, we really don't know how much of an effect this could have over the long term. We're looking for more of a short-term effect.
Okay, so if we do see a pullback, it seems like you might be indicating here, Daniel, is this a 10% correction, what some would deem just a healthy pullback amid what has been a historic V-shaped recovery since the lows that we saw in April, or are you thinking something more drastic?
I'm not great at trying to tell you exactly how much the markets could adjust, but I can tell you that to get these historically high ratios into a more normal territory, you would need more of a 10% adjustment, unless profits were suddenly to surge. And of course, that would bring these ratios back more into line. But I don't really see the prospect of that happening, especially with slack consumer demand right now.
Interesting. And so in terms of where we go from here, any particular stocks, sectors on your radar, Daniel, that could give us a good sense of the overall market?
That's a great question because, as I said, the big indices are being pushed by these tech giants. And when we look at a more broad view of the economy, and a view that's not dependent on the AI boom, like looking at Russell 2000 or something like that, you're not seeing quite the same valuations. And so if you want to see what's really happening in the bulk of the economy, I think it's important to look at those smaller stock-driven indices. But overall, I think the big question here is what's going to happen in the long-term fiscal picture, the long-term credit markets picture. And that's going to be much more important for driving where the market goes. We're possibly facing a big depreciation in the dollar and budget crisis in other countries as well, some of the largest economies in the world. For me, that's going to be much more important.
Daniel Altman, founder of High Yield Economics, joining me remotely this morning. Daniel, thank you.